Bitcoin waits below $75,000 as regulators clear the fog and markets still refuse to believe the rules changed, but price did not. That is the paradox. When uncertainty thins, you expect motion. Instead, Bitcoin sits beneath resistance like a spring, compressed by invisible hands. We see the clarity. The market sees the wall. U.S. regulators have finally drawn cleaner lines around crypto tokens, reducing one source of confusion that has haunted exchanges, issuers, and institutions for years. Yet Bitcoin remains trapped below a level traders now treat like a gatekeeper to higher conviction. The message is simple and uncomfortable. We can remove fog and still discover that fear was doing the real work all along. You see it now, don't you? The market does not reward truth on schedule. It rewards belief when belief becomes urgent enough to pay for itself. Bitcoin hovering below $75,000 tells us something deeper than short-term hesitation. It tells us that markets do not move merely because a headline sounds constructive or because an agency publishes language that looks friendlier than before. Markets move when capital decides that uncertainty has been discounted enough to become opportunity again. Until then, we get this strange silence, a price that refuses to explode even after the official machinery makes itself more readable. We should not mistake readability for liberation. The new joint guidance from the CFTC does something important. It sorts crypto tokens into clearer buckets: digital commodities, digital collectibles, digital tools, stablecoins, digital securities. 5 labels, each pretending to tame a different animal in the same cage. This matters because ambiguity is expensive. When no one knows whether an asset will be treated as a security tomorrow or something else entirely next month, capital behaves like a cautious guest in a house where the lights keep flickering. That kind of uncertainty slows issuance, complicates exchange listings, and poisons product design before it begins. So yes, this is progress. But progress in law is not always progress in price. The guidance is interpretive rather than binding. That distinction matters more than most people want to admit, because markets are built on incentives, not ceremonial optimism. A formal rule changes behavior with weight. Interpretive guidance changes behavior with suggestion. The other nudges them and hopes reality follows politely behind. It rarely does on command. And here's the quiet contradiction. Traders often demand clarity while secretly loving disorder, because disorder creates volatility, and volatility, read stories about easy money. Then when clarity arrives, even partial clarity, they hesitate, because part of them depended on chaos remaining profitable long enough to exit at someone else's expense. That is human action in its raw form. We say we want certainty. We trade best when uncertainty pays us. Then we call it prudence when we wait. Bitcoin's failure to break above $75,000 after this regulatory development shows how much of its near-term structure remains governed by technical thresholds rather than by legal milestones alone. A chart does not care about your excitement. It only records where buyers became exhausted and where sellers discovered confidence again. Around $75,400 to $76,000, Bitcoin meets resistance that traders are now treating as decisive territory, not because numbers possess magic. Because memory does. Price remembers where conviction failed before. And when memory gathers enough participants around one level, it becomes self-fulfilling until it breaks or everyone gives up, pretending they know what comes next. This month already gave Bitcoin a bounce from around $65,000 toward the edge of $76,000 at one point on Tuesday. On paper, that sounds like strength. In practice, it looks more like pressure testing. A market can rally without healing. It can rise without resolving doubt. It can climb simply because too many people are positioned wrong against it, until it reaches the place where fresh conviction must appear, or a moment too. Years of exhaustion, that is why resistance matters. not a superstition, as evidence of remaining hesitation. And if you listen carefully beneath the numbers, you can hear what traders are really reacting to. Not just regulation from Washington, but policy uncertainty from everywhere else in the system. The Federal Reserve looms over this market like gravity dressed in ceremony. Later Wednesday, officials are expected to leave rates unchanged in the 3.5% to 3.75% range, which means no dramatic shock from the decision itself. But markets do not only trade what happens, they trade what might be implied by what happened. So attention shifts toward projections, toward language, toward hints buried inside economic forecasts after an energy price shock tied to war-related tensions away. That is where speculation becomes almost theatrical. Because if rates stay still while inflation fears stir through energy costs, then traders begin asking whether policy will remain tight longer than hoped. And if policy remains tight longer than hoped, then risk assets lose some of their appetite for expansion. Bitcoin lives inside that tension every day now. Part monetary rebellion, part liquidity-sensitive asset, part refuge narrative competing with Meteor. Oh, gravity! Which story wins? The one with more capital behind it? Microhook. What if clarity was never enough? What if price needed permission from liquidity first? This is why so many people misunderstand Bitcoin's behavior at moments like this. They look for a single trigger: regulation, adoption, ETF flows, rate cuts, geopolitical stress, as though markets were mechanical devices waiting for one correct button press UI. But human action is messier than that. Capital arrives slowly when confidence must be rebuilt through layered evidence. It retreats quickly when policy risk feels unresolved. So even landmark regulatory movement may fail to ignite immediate upside if another force dominates trader psychology. And right now, that force may be caution around macro conditions more than enthusiasm over legal cleanup. There's another layer too. The broader crypto market has not validated any heroic thesis yet. XRP, Ether, Solana, all choppy. The CoinDesk 20 drifting lower. Nothing here screams broad-based conviction. This matters because leadership without confirmation often becomes loneliness dressed up as strength. Bitcoin cannot always carry sentiment alone. Sometimes it leads. Sometimes it waits for others to stop pretending they are independent passengers while secretly following its direction anyway. But today those other names are wobbling too. And wobbling markets do not inspire aggressive bidding. They invite patience from buyers and frustration from everyone else who wanted clean continuation instead of hesitation. Tagas Capital described the practical effect well enough. Less legal uncertainty, reduced risk of retroactive enforcement, more predictable compliance. And that language sounds technical because truth often enters finance wearing gray clothing. Watch way. Yet underneath those words lies something far larger. Institutions prefer systems they can model, not perfect systems, modelable ones. When rules become legible, capital can enter with fewer lawyers standing between fear and execution. That should matter enormously over time. It supports exchange development. It supports product innovation. It improves price discovery by lowering friction around participation. But again, over time matters differently than today's candle chart. Markets compress eternity into hours only when greed gets impatient. Otherwise, they stretch revelation across months while pretending each day is day. Another microhook. If this was such good news, why didn't price celebrate? Because celebration requires conviction beyond paperwork. A market does not cheer merely because future participation becomes easier. It cheers when participants believe others will chase them into higher prices soon enough to make waiting feel expensive. Right now, Bitcoin seems caught between two forms of anticipation: the long-term anticipation of institutional normalization and the immediate anticipation of central bank restraint meeting geopolitical inflation fears. One pulls upward through structural legitimacy, the other presses down through liquidity caution. Between them sits a chart line near $75,000, asking who will blink first. This is why the absence of breakout tells us almost as much as breakout would have told us. A market under pressure after regulatory improvement suggests something subtle. The thesis was already partly priced, or confidence remains too fractious. Ready to respond aggressively, or both at once. And maybe that should humble everyone watching this space through slogans instead of structure. People love narratives about inevitability until inevitability has to pay rent in real time. Then they discover markets are less interested in speeches than in settlement behavior. You cannot print trust into existence. You cannot decree urgency either. You can only reduce barriers until capital decides movement is worth its risk again. That is what these new U.S. guidelines attempt to do. Not create adoption out of thin air, just remove some causes for paralysis among serious actors who dislike ambiguity more than they dislike missing. Early upside. There is dignity in that process, even if price refuses immediate applause. A mature market often grows quietly before everyone notices it has changed shape. By then, the loudest critics have already finished explaining why nothing happened fast enough for their taste. And yet, we should remain precise. This guidance still leaves room for case-by-case interpretation, which means discretion survives, which means errors still matter, which means ambiguity has merely narrowed rather than disappeared. In other words, the fog lifted, but not completely. The road became visible, but not frictionless. The vehicle moved forward, but perhaps only are enough for traders to realize their engine still depends on macro fuel they do not control. That dependence matters especially now because interest rate policy acts like an oxygen supply for speculative appetite. When borrowing conditions remain restrictive or uncertain, enthusiasm gets rationed. Risk assets then need stronger justification for premium valuations. Otherwise, they drift sideways while investors wait for cleaner signals from central banks or inflation data, or geopolitical stabilization, ideally all three at once. Though history rarely grants such convenience, we live inside coordination problems disguised as headlines. One agency clarifies classification, another agency controls money's temperature. Markets decide whether either one deserves immediate respect. So let's say it plainly, regulatory clarity. It helps build bridges, but bridges matter most when traffic wants somewhere badly enough to cross them. Right now, Bitcoin may be proving that desire exists, just not urgently enough yet. And there's wisdom in resisting premature euphoria here. A fail. Breakout after major good news can reveal two things. Either sellers are stronger than expected, or buyers need one more layer of confirmation or committing real size. Both interpretations point back to scarcity, not just scarcity of coins, but scarcity of conviction. People talk about institutional adoption, as though institutions were monolithic creatures waking up all at once. They are not. They move through committees, compliance departments, mandate restrictions, internal politics, custody concerns, reputational math. They enter gradually because responsibility enters gradually. So even favorable rules take time before balance sheets reflect them meaningfully. Meanwhile, retail traders stare at resistance lines as if lines themselves were decisions, and minds are only memories made visible. They mark where hope previously met supply. They remember disappointment, better tea. On average, participants do, and memory governs repetition more powerfully than opinion ever could. If Bitcoin breaks above this zone decisively then today's hesitation will look like accumulation under pressure. If it fails repeatedly, then this will read as distribution masked by optimism. That distinction will matter enormously because markets always reinterpret silence after outcome reveals which side had conviction for now. We remain inside uncertainty, where every participant claims patience but few actually possess it. because patience without position size dish diet. Pipeline turns into procrastination, and procrastination dressed up as wisdom costs people years while making them feel sophisticated about waiting. That's one reason Bitcoin continues attracting serious attention despite short-term stagnation. It forces every observer into contact with time. Hence, you either understand delayed gratification or you outsource your future judgment to whatever candle currently feels comforting. There isn't much mid. The ground once money begins testing your beliefs against volatility. The we setup offers exactly that test. Clarity on regulation, uncertain on rates, energy shock reverberations through inflation expectations, choppy altcoins, and Bitcoin pinned below an obvious ceiling everyone pretends. NDS isn't psychological until price fails there. Twice markets love irony with expensive consequences. The Fed meeting later today may not change raw tests, but its projections could change how long traders believe restrictive conditions will persist, and how long often matters more than how much. Duration affects positioning, positioning affects flows, flows affect levels, levels affect headlines, headlines feed back into emotion. This loop never stops, only changes costume, so yes, we should recognize what regulators did here. They reduced some noise, they gave issuers an exuberant hang clearer categories. They moved federal treatment away from pure case-by-case haze towards something closer to structure that deserves acknowledgement, but we should also recognize what markets said back. Not yet meaning, not yet convinced by legal framing alone, not yet ready to reprice macro caution, not yet willing to declare victory over resistance just because policymakers improve their vocabulary. Perhaps that tension itself is healthy. Perhaps prices need time precisely because real change must pass through layers psychology cannot skip, or perhaps we're watching an other familiar scene. Policy catches up late, participants celebrate early, and costless optimism collides with costly reality once again. Either there is no mystery here once you strip away noise. Bitcoin remains above many historical levels, yet beneath an important threshold. Reduced ambiguity, yet did not create binding law. Macro conditions remain heavy, yet no panic dominates, and so price stands still long enough for everyone involved to project their own desire onto it. That stillness speaks louder than excitement would have today. Stillness says capital wants proof. Stillness says conviction has a bid but no urgency. Stillness says every apparent advance must still answer one question. Can demand persist once headlines fade? Because headlines always fade, liquidity doesn't always return. And markets built on hope eventually meet arithmetic. If you want the deepest reading here, it's simple as Bitcoin was given clearer rules. But freedom doesn't become valuable just because bureaucracy approves its outline. It becomes valuable when people decide custody matters more than convenience, when sovereignty matters more than slogans, when holding your own future feels preferably to renting someone else's confidence. That decision cannot be forced by regulators. It can only be revealed by price over time. So we watch this out carefully, not worshipping $75,000, not fearing it either, just recognizing what threshold means in human action, a place where belief must become commitment or retreat, disguises itself as patience maybe. Tomorrow brings breakout, maybe another rejection teaches us something cleaner first. Maybe Powell speaks and shifts expectations just enough to turn restraint into fuel again. For now we stand at the edge between interpretation and impulse. And the market remains honest in its own cold way. It has heard the news. It simply hasn't decided what news deserves payment yet. We are block sonic. We don't chase candles. We read what hesitation reveals beneath them, and maybe that's the real story tonight. When truth arrives before liquidity, then good news must wait outside until capital opens the door. So ask yourself quietly, what exactly are we waiting for?